Hello, everyone, and welcome to our webinar on expenses and accounts payable. Okay, so expenses, just like our revenue, are probably one of the most important things we see on our financial reports and in our operations, because expenses are costs of our operations, of providing program activities and supplies. So let's go through types of expenses that we normally see in operations and in our financial reporting. Number one is program delivery costs. And again, our training here is tailored to First Nations and related nonprofits, related organizations. We will speak a little bit about businesses because many of our First Nations operate successful and profitable businesses or aspire to do so. So in general, for a First Nation or related nonprofit, the majority of our costs would be under the program delivery category. So we will have payroll costs. Our wages and benefits are normally very significant because our staff are the ones performing program activities. We may have some subcontract costs and professional fees. Then we have program supplies and different purchases within the program. And another category that tends to be quite high is travel, because most of our communities are quite remote, and unless we're during a COVID period or some sort of other lockdown, maybe isolation period, we do need travel, which can be costly. So the second category of expenses is administration and overhead. So those would be things like office expenses, maybe computers, computer support, utilities. So any sort of admin costs that are required for running the programs. Now, in the admin costs, sometimes what we include is allocation for administration from the band or from maybe a parent organization, just to pay for the costs of managing our program. And we'll talk about it further. We can also have a third category, which is other expenses. So those would be more of a non-recurring or unusual or not really directly related to our operations or even administration costs. So they would include things such as legal settlements. So if we got sued, unfortunately, and lost, then a cost of that loss would be included in other expenses, because it's not really a part of us providing programs and services. It's more unusual. We can be paying interest on loans. This is normally considered a part of other expenses as well. We can't include it in program expenses normally because the Queen of Canada doesn't pay interest. Okay, then we can have a loss on sale of assets. So if we have, say, a vehicle or a building, an asset that we own long-term, we sell it. If there is a loss on that sale, that's not a recurring cost, not a recurring expense. So that would be presented likely under other expenses. So let's talk about expense account or categories, how they're presented in different financial statements and different financial reports and settings. So expense accounts are always below the revenue on the income statement. Other expense accounts, all those legal settlements and loss on sale of assets, would be at the bottom, completely at the bottom, below program and administration expenses. So accounts normally are set up by expense type. So again, here, just like in revenue, we really have to consider the needs of the users. So the users for our financial reporting are our funders, right? So Indigenous Services Canada, CMHC, whoever else we work with, but also, and obviously most important, it's our members, our community members, chief and council, program managers. So for financial reporting to be useful, for it to be meaningful to our users, our expenses need to be set up in categories that make sense to the users. Okay, normally they're really straightforward. They can be like wages and salaries, subcontracts, travel, office, IT, whatever makes sense, right? When we consider funders, many times funders would provide us with a budget. In particular, if we have a program that we submitted a proposal for, it would be an approved budget in that program. And that budget would list eligible expense categories. And so it's very helpful in this case for us to classify program expenses in accordance with the budget, so that when the funder reviews our financial reports, they're able to relate it very easily to their budget and to what's eligible and how much was spent. So it's meaningful to everyone, right? So we can see overspending or underspending right in the categories set up by the funder. Okay. Now, if we look at financial statement audits for First Nations, then their expenses are listed by program. Why is that? Because there's so many programs for First Nations that listing it just by category, like wages and and travel and so on, could be less meaningful to funders. So, and going back to the audits, like to explain a little further, so for financial statement audits for First Nations, we have two sets of financial statements. So there is the main audit that would have the main income statement with our revenue and expenses. On that main income statement, our revenue and expenses would be listed. So for expenses they'd be listed by program, so such as say band programs, infrastructure, health, education, and revenue would be listed by funder, ISC, CMHC, Health Canada, so on and so forth. So that's just the overall income statement for the First Nation. Now, in addition to that, the auditors would produce what's called schedules to financial statements. So those schedules would actually have an income statement for each funded program. So in that case, it would go into every funding stream that's on our contribution agreement from the funders. Every funding stream would have revenue and would have expenses listed by expense category. Okay, so that would be something that we are more used to seeing in our systems, in our accounting software. Expenses in those schedules would be listed by categories we're used to. So it would be wages, would be travel, would be office, and so on. Okay, so now, while your main audit is really important, because obviously it's the overall financial report for the First Nation, the schedules become even more important, because this is what our funders use to decide whether we performed the program properly and whether there is a surplus or deficit for each funding stream at the end of a fiscal year. Okay, so just to I'm bringing this up, even though this is not a part of the presentation here, just to say, depending on what we're presenting, our expenses, just like revenue, can be grouped in different ways that are appropriate for the purpose of the financial report, that are most useful to the users. Okay. So another thing to remember, it's really good to provide details, but also to stay concise. Sometimes we see financial reports that would be too detailed. So instead of, say, having one line for office, we can see a financial report that has a line for office supplies, then maybe computer supplies, then, I don't know, pens and pencils. I'm just exaggerating, but what I wanted to say is important to have a good balance of providing details, but not too many details, because when a user looks at the financial reports and it's very long with lots of numbers, they can lose their focus and they can, not get meaningful information out of it. Okay, so let's stop here for a second and look at some examples. Okay, so my first example is just an internal financial statement for a First Nation. In this case, we're looking at income assistance. They present the revenue at the top. You can see the expenses come right under the revenue. And here they're grouped by expense category that are meaningful to the funders and also to the First Nations. So there is the basic needs expense, there is shelter allowance, user fees, and so on and so forth. Okay. Then my second example here, again, internal financial statements for a First Nation. So they operate in an arena complex where all the then businesses are, and it includes the gaming operation, a restaurant, a smoke shop, community hall. So you'll see here expenses again are right under revenue, and they do have some different categories that are more meaningful to those businesses. So for instance, all the gaming expenses are presented separately from overhead. Then payroll expenses are separate, and then general and administrative expenses are separate, and they're grouped by categories that make sense for that business. So let's take a look at another example. So this example here is the famous Apple Inc. I like using Apple as an example because I feel it's very concise. Like, we don't feel overwhelmed with information when we look at it because it's just short and to the point. This is why I like to use it. Easy to understand. So you'll see here, they divide their sales to products and services, and also cost of sales, which are direct expenses. We'll talk about that in a few moments, to as well, cost of products and cost of services. And then for their operating expenses, they just divided to two major categories, which is research and development. I think we all can guess that they spend a lot of money on developing new products and services. And then selling, general, and administrative. Okay, so this is almost too concise, right? Like if we were to submit something like this to the government, they probably wouldn't like us. But to illustrate how financial reporting can be simple and useful, I like to use that statement. You'll see that here too, there is some other income or expense which is presented below their expenses, revenue, expenses, and income from operation. Our next example is a First Nation audit. So our revenue is at the top. And then as we get to expenses, this is the main audit, the main statement produced by the auditors. So here you'll see that expenses are actually presented by program. Okay. So there's governance and administration, housing, community services, and so on and so forth. Okay. So now that we've reviewed how expenses presented in different operations, let's speak a bit further about something very specific for a business, for a commercial business operation. So in a commercial business operation, it becomes very important to track direct costs of our sales. So for instance, if I'm selling pens, right? If my business is all about selling pens, say I can sell a pen for $5, that's my sales, but then the cost of this pen, I buy it somewhere in China maybe, or India, for $2. So in my example, my sales for one pen would be $5. And then my cost of sales, which is the direct cost of this pen, is $2, right? And then based on those two numbers, the difference is what's called my gross profit. So $5 minus $2 is $3. This is how much profit, gross profit, I make on every pen I sell. Okay. So why is it important in a business? Well, it really helps us analyze which product lines are more profitable. So say if I sell pens, but maybe I also sell pencils, and my gross profit on pens is $3, but on pencils, it's maybe $2. Then, I can consider selling more pens as opposed to pencil. Or maybe there is a different pen that has a greater gross profit. Again, this just gives me the flexibility to decide what products are more profitable, what I want to focus on, okay? In addition, gross profit is what keeps my business running, because gross profit is used to cover my overhead costs. So all those costs that are there, whether I sell in my business or I don't, unless I have the sales and gross profit, I can't cover those costs. So that would be, say, bills and rent, utilities, maybe some wages, maybe some office expenses. Those costs are always there, whether I'm selling my products or not. And so it's important for a business to generate sufficient profit to cover those overhead costs. And this is why it's one of the reasons why in a business we really like to keep track of that gross profit. So now a gross profit formula is very simple. So gross profit equals sales minus cost of sales, which again are direct expenses. And then gross profit percentage is the gross profit amount I calculated divided by the sales. Okay, so let's look for a minute here at an example. So here I have a community store and their income statement or profit and loss. So first, let's look at what expenses look like, because we're speaking about expenses in this session. So expenses are all presented under my revenue, and then expenses are divided into this cost of sales. It can also be referred to as cost of goods sold. Then I have a gross profit calculation, and then I have the rest of the expenses. In this case, they keep track of payroll expenses separately because they're the highest expense category. And then there is the general and administrative expenses, okay, listed by categories that make sense for this business, for the community store. So let's look at our gross profit concept. You'll see here that gross profit depends on how much I sell, right? Because the calculation is sales that are coming in minus the cost of those sales. So if I'm selling gas, then gas sales minus the cost of gas that I had to pay to the vendor, okay? And then, so my gross profit will depend on the amount of sales I had in the business, right? But then the expenses underneath the gross profit, like my payroll expenses and general and administrative expenses, they never change, right? I mean, I can be proactive and maybe lay off some employees if my business stays closed for COVID, right? And maybe try to cut some costs, but really those costs in general are pretty fixed. I have a set number of employees working at the store, getting a pretty set amount of wages, and I have a pretty set expenses there for, for office supplies and professional fees, and so on and so forth under general administrative. Okay, so now for me, if I'm reviewing this store and I want to make sure that it generates enough and it's profitable, I'm going to look at that gross profit number. Okay, and in this case, the community likes to track both sales and cost of sales by different product lines. So you'll see here I have grocery, tobacco, gas, and retail. Okay, so I've already done a calculation here. You see sales presented here by product line, then there is cost of goods sold by product line, and then gross profit for each product line, right? And then you'll see here that for grocery, my gross profit is 21%. So that's pretty profitable line, right? Then for tobacco, it's only 5%. And for gas, it's only 6%. So you can see that gas and tobacco really don't generate much profit. And for me to make a lot of money on selling gas and tobacco, I have to sell a lot of it. Okay. Now, fortunately for this store, they do sell a lot of gas, right? That's like the majority of their sales. So my overall gross profit from gas sale is almost $130,000, which is nice. But the percentage of profitability within it is really low, which is good for me to know as a store operator. Okay. And then they sell something that's called retail, which generates a very big profit, but they sell only a little bit of it, so it's not very meaningful in the end. They only make $4,000 in gross profit from it. Okay, so it's just a concept that is important to keep in mind for all the businesses our communities may be running. Okay, it's good for understanding how profitable our business is. And it's related to expenses, because we're talking about expenses here. It's important to keep track of direct costs, of cost of goods sold, separately from overhead costs. Okay, so when we record expenses, we can either use a two-step approach or one-step approach. So in a two-step approach is when there is a timing difference between us receiving a product from a vendor and receiving an invoice and making a payment. Okay, and so just to remind us all, for our bookkeeping, for financial statement audits, and for all the reporting, we use what's called an accrual basis of accounting. And one of the main principles of accrual basis of accounting is matching of revenue and expenses. So if an expense happens in a certain period, it has to be recorded in that period, regardless of when I'm actually paying for it. Okay, so if I have a school at the community that bought gas from community store, but they're not going to pay for that gas until a month from now, well, really we should be recording an expense right at the time of the purchase, because this is when an obligation to pay was created. This is when the spending actually happened, regardless of when the cash flows for payment. Okay, so in a two-step approach, we use a vendor invoice. We record an expense as of the invoice date, which is normally the date of when the service or product was provided to us. And remember here, we're paying later. So when we record an invoice, it goes into the appropriate expense. So in my example of a community school, it would go into fuel or gas expenses, right? But then the fact that we owe a vendor, that we owe the store, is going to be reflected in accounts payable, which is a holding place for amounts we owe to vendors and are going to pay later. Okay, so again, a two-step approach, because there is two steps. One, we bought a service or goods, and two, we made the payments, and there is a time lag between the two. Now, sometimes there is no time lag. Sometimes everything happens at once. Say a school bus driver walks into a community store, puts gas into the bus, and pays with a credit card. Maybe that happens somewhere. So if a payment happens right at the time of receiving a service or product, then we don't have to use a two-step approach. We can just record an expense, in which case we'll record a gas expense offset to credit card or cash, right? Because we paid with a credit card or cash. Sometimes we use journal entries. So journal entries are a more sophisticated accounting transactions, and they require understanding debits and credits and all the other fun things that we're going to learn further in our webinars. Now, with journal entries, it's important to remember the auditors will test 100% of your journal entries. So really what that means is journal entries are subject to more manipulation than just using your expense and account payable modules of your software. So if you can stay away from using journal entries, please do so and just use vendor invoices or expenses and payments. Now, for some software that are more intended for bigger organizations and maybe older, sometimes you have to use journal entries because that's the only way. So it's important to understand what software your organization is working with and learn what's required. And sometimes there is no way and you have to use journal entries, which is okay. The auditors will adjust to that. So accounts payable, again, these are amounts owed to vendors. It's a liability or debt showed in our balance sheet. So when we record a vendor invoice, the amount is held in accounts payable until a payment is made. Accrual basis of accounting requires recording accounts payable. And remember, it's especially important when we're doing a year end, right? When we're getting ready for the audit, our auditors are going to be all over, okay, what do you owe vendors? What expenses are not in the system yet that need to be there? And then another tool that we have based on our accounts and records is what's called Aged Accounts Payable Report. So this is a summary report that shows amounts owed to different vendors, including the agent, how old those amounts are. Okay, it's important to review that on a regular basis. For one thing, this way we can make sure we pay our vendors on time. And then also, sometimes we can notice things that maybe were paid but weren't applied properly, so they need to come off our accounts payable, because if we recorded something as an account payable and it was paid else how and not applied to payable, my expense is now double. I recorded the expense twice. Okay, so let's look at the quick example here for accounts payable agent summary. So this one is for a construction company, okay? And it's pretty straightforward. So you'll see here a list of different vendors this construction company is using, the amounts owed to those vendors. So there is a total for every vendor, and then a breakdown to how current or old the amounts are. So when we review this, we may want to pay attention to the older amounts, right? Because why are they still outstanding? Is there a dispute with the vendor? Is it really still owed? Or maybe, maybe we recorded the payment else how without applying it to payables, and then it needs to be, cleaned up here from accounts payable listing, okay? In general, if you review an aged accounts payable listing for an organization, what you want to do is maybe take a look at the overall aging of accounts payable. So in my case here, total accounts payable are $428,000. And then the breakdown here is pretty even, but I'd say the majority of accounts payable is current, right? You see the majority here is pretty current. But if I see a business where a big part of accounts payable is in over 90 days, then it raises a flag about the financial management and sustainability of that business, because why are they not paying their vendors, right? Maybe there's cash flow issues, maybe there is some sort of an operational story or a dispute, but that's something we kind of want to keep an eye on when reviewing aged accounts payable. Okay, so let's take a quick walkthrough through accounting. So when we have a two-step approach, so we have a vendor bill, what's going to happen in our system is first we will record the bill or invoice, and then we will show an expense and accounts payable. And then we make a payment, say a month later, then we will reduce the account payable by the payment and obviously show the withdrawal from the bank. Okay, now in a one-step approach, there is no accounts payable are involved. So the end result is exactly the same as in a two-step approach, right? So we have an expense, increase in expense and reduction to our bank account, but we just didn't use accounts payable because the purchase wasn't on account. Now, when we review our aged accounts payable report and we see that some vendor, some amount shouldn't really be there because they got paid and not applied, we have to make adjustments. Okay, we have to adjust those amounts. So when we adjust those amounts, the best thing to do is to apply vendor credit. So if we use things like a journal entry instead, it may not be applied to the correct vendor account. So always try to go through vendor credits as opposed to journal entries for the ones of you that use journal entries. So another thing that is very useful is when you review your accounts payable agent summary or report and you're unsure about some vendor balances, it's good to compare to vendor statements. One of the processes that I recommend to all accountants is contact your vendors and give them your email address and your phone number. So instead of going just to your program managers or program staff, they can send invoices and statements directly to you because you're in accounting and you want to make sure all the expenses for the program are captured on a timely basis, right? And so what I do sometimes, if I look at my aged payables report, especially when I'm preparing for an audit, and I go, looks like I owe this vendor an older amount and I'm not sure about it, then all I have to do is to compare the amount in my system to the amount in that vendor statement. And if I don't have the statement, I just email a vendor and say, hey, can you send me a statement as of March 31st, how much we owed you? And then I just compare and make sure that my system agrees to the vendor system and everything is correct. So let's talk about expense allocation, because most of our First Nations and related organizations are running funded programs. Then the majority of our expenses really relate to funded programs. And even if some of them are kind of not so clearly related, it's really important to allocate as much as possible to program costs as opposed to administration or general expenses. So definitely review maybe with program managers, with program staff, review all your costs to make sure they're allocated properly as program costs. So now from experience, most programs, most funded programs would allow for up to 15% in admin costs. So what that means is, for instance, in the First Nation that's running a health department, Health Canada funding is separate from Indigenous Services Canada. And health department, normally they have their own management and staff. but to reflect the fact that chief and council are constantly involved in managing the health department from a higher level and providing that leadership, oversight, and directions from leadership. We're allowed to charge what's called admin costs. So then effectively the health department, every program in there can record admin costs and pay costs to the band for the fact that the band chief and council provide management oversight to the department. I've never seen admin allocations under 15% or 15% and under questions, so that kind of seems to be an acceptable amount. So if you have programs in your community that run a surplus, which for funded programs is not really what we want, because for some of them we have to repay surplus. If we don't repay them, we carry over, and in every following year we have to worry about it again. Did we spend it? Do we still have a surplus, right? Then consider allocating some of those admin costs. If your chief and council constantly provide oversight for a program, then it's very reasonable to allocate some of the costs to the band in that program. So having a small deficit in a funded program is always preferred. And it is important to understand eligible costs for every program, because sometimes they're very strict. Sometimes you have say a budget from a proposal that's, you know, very strict and tells you exactly what qualifies, what doesn't qualify, and then you have to follow that. And sometimes it's kind of very open to interpretations, kind of vague. And you know, for us accountants, when we see something that's not very structured or strict, that is kind of open and vague, we don't like it normally. That's my first response. Like, well, I don't know what this means, what qualifies, right? But really, it's important to remember, the more vague it is, the more costs are eligible, the more creative you can get with providing services to your community through that program. Okay. So let's talk about best practices for expenses. So two-step approach when you use accounts payable is always preferred, just because then the timing of expenses agrees to when we actually receive the product or service, right? And it has to be used at year end. So at year end, when we're doing our audit prep, we really have to contact vendors and get all the statements, all the invoices that belong to our year, because some of them are slow, right? Sometimes we don't get invoices for March until April or May or even June, depending on the vendor, right? I don't know what your experience is. My experience with lawyers is always bad. They're, you know, they provide really good services, but they're not quick with their bills sometimes. And, you know, sometimes we get a bill in August that belongs to March, right? And by that time, it could be too late to include it in the year. So if you know that certain vendors have significant bills that are kind of late to bill, definitely proactively contact them when you're doing your audit prep and say, okay, I need the bill up to March 31st. So record vendor invoices as soon as received to ensure that program spending in our records is up to date. Ask program managers and staff for vendor invoices they haven't submitted or are expecting. So that's one way. Another way is have a direct contact with the vendors and ask them yourself. So make a contact with major vendors, like we said. And then program managers should receive and review monthly budget to actual reports. Again, this is the best practices. If it's not realistic and we only do quarterly, or maybe maybe we're behind and we can only do a year-end review, that's better than not having a review. Because the issue is only the program managers know how much they plan to spend and how much was actually spent. What we record in accounting just depends on the documents we receive, right? And sometimes we don't know what they have in their mind. And so the last thing we want to do is to send our records to the auditors and then have a surplus in a program when in fact there shouldn't be a surplus. And then in the end, people come to accountant and say, well, why is it showing a surplus, right? So for us not to get into those situations, the moment we have a statement ready for review or for sending to the auditors, we give it to the program managers and say, okay, does this make sense? Did we capture all the spending for this program and all the funding received? Okay, once they reviewed and okayed it, it becomes their responsibility. Nobody comes back to accountant to say, oh, this wasn't recorded correctly. Okay, now all expenses should be approved by program managers or at least by program staff. Use check requisitions, travel requisitions, any sort of approval forms that your organization uses. That's a really good practice. Again, why is it important? Well, to make sure that only eligible expenses are incurred, to make sure there is no fraud or error, and to make sure that program managers are really taking responsibility for spending in their program. Okay, dual signatures on checks and EFTs with supporting documents initial for approval. Why is that important? Well, of course, we're trying to prevent fraud and error, right? Because if one person has access to making payments and something happens in their life, or they just happen to be dishonest, if there's only one signature required for approval, then there is a greater chance that they will be dishonest. And second signature for approval is that's a deterrent, right? And that's prevention for fraud and error. Set up online access to bank and credit card statements and reconcile on a monthly basis. So I think in 2 sessions, we're going to be talking about reconciliation, but basically what it does, it verifies that my records are complete, that everything that went through the bank and my credit cards is reflected in my records. Okay, and so those reconciliations are good to do as a process to make sure all the expenses are recorded in my system in correct amounts and the timing is correct as well. So chief and counsel and our management should review accounts payable listing on a regular basis. So in particular, if you running into a low cash flow situation, right, you want to make leadership and management aware of all this outstanding vendor amounts that need to be paid, because at some point those vendors will start calling and asking for payment, and whoever is managing the cash flow really needs to be aware of those obligations. Now, allocating expenses to programs, we spoke about if there is a budget or program guidelines. It's really important to follow that for understanding eligible expenses and making sure we only allocate eligible expenses to proper categories. And then consider allocating indirect costs related to programs, such as chief and counsel honorarium and travel. So for instance, one of my communities had a big business purchase. And then as a part of negotiation, chief and counsel had to travel and spend a lot of time meeting with professional advisors, meeting with the business owners that were selling the business. And now all this travel and honorarium for chief and counsel, majority of it is recorded in bank support, right? And so when we reviewed the the program for economic development for person-led business, we said, well, in reality, some of chief and counsel honorarium really relates here, like really belongs here, because one person on chief and counsel spent probably 2 months full time just working on that business. And so we allocated some of the honorarium for that person and definitely all the related travel to that program, which was important because we had a bit of a surplus in there. So this way we were able to not report a surplus. And then consider charging admin fees for ban administration, just like we talked about chicken council oversight. If you have programs, say in health, in education, anywhere else you may have a surplus. I want to say housing, but I'm yet to see a housing program with a surplus. So wherever you have a program with a surplus, consider if there is strong oversight, a significant oversight provided by the bank, by chief and council, and if appropriate, record that admin fee of up to 15%. Maybe in your case, 5% is more appropriate, maybe it's even 2%, but it's still something to reduce that surplus, to record more expenses in the program. Okay, thank you for your time.